And Texter says, my dad left me an IRA of $300,000, $200,000 in a traditional IRA and $100,000 in a Roth. What are the rules now about inheriting an IRA? Is there a difference between a traditional and a Roth IRA? Thank you.
That's a great question. Well, there is a difference in terms of the taxation between a traditional IRA and a Roth IRA. We covered this in our first segment of the show, which is that you will be required to take distributions from the Roth account. However, they won't be taxable to you. So the same rules apply, which are that over the next 10 years, you'll need to liquidate both of those accounts. If your dad was 72 when he passed away, so if he passed away last year and was taking requirement and had started taking his required minimum distribution from the traditional IRA account, you will have to pull at least about $8,000, which would be his required minimum distribution for the year, or you can take as much as you'd like. With the Roth account, because he wasn't required to take minimum distributions, you don't have to take a minimum out of that account, but you will also have to liquidate it by the 10th year.
Yeah, and again, one of the big questions that usually follows up on this is, can I take those new accounts and then merge them with our accounts, with my accounts? And the answer is no. And the reason that you can't is because the IRS doesn't really consider this, even though you inherited it as your money. They really look at it as the person who was giving you the money.
So dad in this case?
The dad. They really looked at it as dad's money that hadn't been taxed. So, well, it's just true. I mean,
right, undistributed retirement assets.
Right. So one of the things that we suggest to clients, and we're certainly asking those that are the beneficiary of these IRAs, is first question is, are you making the maximum contribution that you can be to your retirement accounts, whether they're IRAs, 401ks, whatever it might be?
Granted that you're still working or earning income in some way.
Yeah, and for most cases, the answer is, we find, is no. Most folks aren't making the maximum contribution. Well, what could happen, we like to call the process reverse engineering, is that you as the inheritor could go to your employer, say reduce my paycheck so that I can increase my contribution to my retirement, my 401k plan as an example, by X. So let's use an example. Let's say you're putting in $12,000 and you have a window of where you could put an extra $12,000. You could take $12,000 distribution from your inherited IRA from dad, which is taxable to you.
And it also meets that potential required minimum distribution if he had one, which would be about $8,000.
Right. And then what would happen is that because you lowered your pay at work by that same amount, it's really a wash in terms of taxes. And so indirectly what you've been able to do is transfer dad's IRA into your IRA.
And if you happen to be married, you might be able to accelerate this process by having your spouse do the exact same thing, which is go to her employer, make sure that she's making the maximum contribution, if not reduce her pay by the amount that will get the maximum contribution into her retirement plan, and make an additional distribution from dad's traditional IRA account, because over 10 years you're going to have to take at least $20,000 a year.
Yes, on average.
On average.
Yeah, and with the Roth, unfortunately, it's tax-free. You could, in theory, take part of this and make Roth contributions, assuming that you fall under the income eligibility limits.
Right.
So, lots of options. You need to talk with your advisor, your tax professional, about setting up the scenario. It makes the most sense for you, but I would tell you that this concept of reverse engineering seems to work very efficiently, and we're using it very often with folks.